Hello, Stephen Koukoulas here, Economist in residence at Zagga. And look, the monthly update this time around is erring on the side of a little bit of disappointment in terms of the economic news. You might recall that in recent months there's been better news on the economy. Household spending was picking up, the GDP results were a little better than expected, building approvals were stronger, and the general sentiment, business confidence, consumer sentiment were all picking up. Now, just in the last month, and I know 1 month doesn't change a trend necessarily, but if we're wanting to see the economy grow at its potential, that is register sort of 2.5% real annual GDP growth, the numbers that have come out recently have been disappointing. So in no particular order, household spending only rose 0.1% in August, and that was after several months of strength. So that's slightly disappointing. And in line with that, the consumer sentiment numbers, which had been pointing up, have tracked back down. So we consumers, we were optimistic in the first half of this year. We've now pared back some of that optimism, and that is feeding into slower growth in household spending. The other thing that's been really disappointing, I've been one of these folk who think that we're set for a pretty solid upturn in building activity, dwelling construction that is in particular. Again, the last 2 months, there's been big falls in the number of building approvals after what was a 30% increase up until June. The last 2 months, we've had a bit of a pullback of about 15%. And so that much needed increase in construction activity, new supply of dwellings, is just faltering. We haven't quite had that momentum to lock in that much needed pickup in economic activity. On the inflation front, choppy numbers on the monthly series, as the Reserve Bank like to tell us. The headline figure did hit 3%, but that was almost exclusively due to an unwind of those electricity subsidies. The trimmed mean, the underlying inflation rate, which takes out some of those volatile items, was at 2.6% in annual terms, so pretty much slap bang in the middle of the target band. So that's sort of the inflation side of the economy. On the labour market, the rate of employment growth is cooling off. A lot of that's linked to the public sector paring back or finishing its hiring plans that have been so strong over the last couple of years. So where are we? The Reserve Bank left interest rates steady on the 30th of September, its last meeting, and the Governor, Michelle Bullock, she sort of painted a bit of a mixed picture, I suppose it's fair to say. Look, she didn't say that, we're not going to cut rates again, far from it. She said that there's still a scenario where if inflation does remain low, if the unemployment rate does tick up and growth doesn't get that traction that we're all hoping that it does, that there'll be rate cuts ahead. And I think that's still the case. As I said, this last month of data has really been a little disappointing, and to me, it reinforces the case for lower interest rates over the course of the next 6 months. The exact timing, the exact date, always a tough one to pinpoint, but there are 2 meetings before the end of the year for the Reserve Bank Monetary Policy Board, one on the 4th of November, another one on the 9th of December. One of those, I think, will still deliver an interest rate cut, which is needed just to rekindle that better economic news on the economy. So all up, we've got this scenario. Growth is okay. The labour market is softening. Inflation's in the target band if we strip out these volatile items. And what we're also seeing too is that house prices are getting some sort of momentum. There's a shortage of dwellings still going through. So if we look at the Catality house price indices, they're moving higher. So the economy, you'd sort of give it a 6 out of 10. It's not failing, it's not disastrous, but we're a long way from getting that growth that we need to ensure that the unemployment rate stays low, that inflation remains on target, and part of that will require interest rate cuts from the RBA. And I said cuts, plural. We need more than one. We need probably at least 2 more, getting the cash rate down to 3.1%, which gets interest rates to a more neutral setting, not a restrictive setting. I think that's a critical thing. So as always, looking forward to hearing from you, looking forward to the next function that Zagga is holding. They're shooting the lights out on many fronts at the moment, and well done to Zagga, and I look forward to talking more about the economy in the weeks and the months ahead. All the very best.